Oh, how young I looked in that intro there. Hey, Dustin Tibbetts here, financial advisor with Jazz Wealth Managers. And this will be a quick one today. Happy Friday, by the way. But it will be a quick one because it's about to rain cats and dogs out there. Cats and dogs. So I would like to get this done and teach you something a little bit interesting. It's actually one of the more fun parts of my job. So for our clients, as they grow with us, we use software we call Nest Egg. And we look into the inner workings, the geeky sort of financial planning that you can do out there. If you're interested, you could look them up. There's only two financial planning softwares that advisors use. We use one of them, and the other one is ePlan or something like that. And they're awesome. They're both awesome. So we call it Nest Egg. We dress it up a little bit. And I want to give you an example today because the fun part of my job is to work through somebody's plan and work out all the numbers and everything, but then work on the investment side. I'm big on the investment side. What's the least amount of risk you can take and not fail, have your plan not fail? So let me give you an example here. This is a model. We're going to change the names to protect the privacy of the innocent. But here we go. We're going to call them Louis Armstrong and Lucille Wilson. I've changed this a little bit. Now, this is a new page for us in here. We can see the probability of success for them is 80%, their net worth at the moment, effective federal tax rate. We've already done all the great planning in here. We can see some of their assets and stuff. We could see the spending of their dollars over the years, their current allocation as far as the investments go, and then how their net worth breaks down by tax. And so that's just that one. But basically, I wanted to do something real quick and show you. You compare yourself to these people. Are you close? Maybe you're older, younger, whatever. But look at what we got. Louis, so I don't say the name. Louis is 50, Lucille's 49. They got a kid that's just turning an adult there. Pre-retirement living expenses, they're not retired yet. $4,300. They filed jointly. Doing some savings in some accounts here, so you can pause here if you want and see the different types of accounts that they're contributing to. But they're doing their thing. They've got income 85 for Louis. Lucille makes 75. And this can go away. There we go. And let's take a look. Their goals are to retire at 63 and 62. In real life, they are, Louis is 1 year older. So this means they're going to retire together. That's what they're trying to do, is retire together. Anyways, retirement expenses, $3,500 there. They've got their health care costs in there. They're paying for kids' college to some degree. They're not paying for all of it. They're going to have to buy a car every now and then, and they know they're going to travel. Basic retirement stuff, right? If we look through their net worth, some checking accounts, they got the emergency fund thing going on. Credit card, not too bad in there for given their net worth. They've got a whole list of investments, some with us, some not, some in HSAs, some in old 401ks and things like that. And there's really nothing else. They own their property outright, so it's not an issue for the moment. Here's the fun part. So what I do, we go through all of this up here. Like the client's job, your job, should you join us here at Jazz, you just fill this stuff out. Stuff I don't know about you, right? But then my job is to go through and figure out how do we pay the least amount of tax. We're working because their child's going to school, so we're helping with that. Do you need insurance of any kind or whatever? We don't sell insurance, but I like to talk about it. Retirement analysis, which I'll just kind of navigate to for the moment. How successful are you likely to be at your goals? In this case, we find out that there's an 82% chance that they're going to be just fine. They'll have some money left over and everything, and here's all the data. Anyways, all of that getting to my point. Let's go to the investment tab. Now that I know they have an 82% chance of being successful, I can actually see the margin of error, is a simple way to say it, of where they may run out of money, where they may not. That's a nice visual representation of that. The bottom line is they're in good shape, right? So now think about this. If you make it to that point, a lot of people don't, right? They open their account, they start investing, they maybe do some rough numbers and stuff. They never make it all the way through the nitty-gritty to get to the really, really important part, which is what's the level of risk that you have to take with all your accounts combined in order to hit your goal, right? Most people are taking too much risk, and that's a byproduct of the stock market just having done well. So most people are taking too much risk to hit the goal. They don't have to. They could bring it down. And so when we have moments like, well, I don't know, right now, where the stock market's all over the place, they don't have to participate as much. You get what I'm saying there? Like, if the stock market's going 100 miles an hour and you're going 170, but you only need to go 50 in order to make the plan successful, then let's go 50, right? Why take more risk than we have to unless you just don't care, right? So let's take a look. We're going to go to the screen. Here's where they stand currently. Here's where they stand currently. 77% in stocks, 23% in bonds or bond equivalents. Over here now, we have set it and we've figured out through the help of software, what is the least amount of risk they have to take? 60% stocks, 40% bonds, and we can actually break it down to the individual numbers there. But this is a simple one to show you. So it's very simple to see they're taking too much risk. Is the client willing to move more money towards cash, bonds, or something equivalent? Or are they happy with the risk? And in particular, how do we know how much we can do? I'm going to actually zoom out so you can see it better, because for whatever reason it's not scrolling, but there you go. They can be $100,000 less in stocks or ETFs that are stock related, all right? So that's a quick example of, whoa, you could scale down. Now, how do they do that? That's my job. My job would be to actually go over here, look through the accounts that we have here at Jazz, look through all the accounts that they have elsewhere and go, oh, well, here's one. You're in the T. Rowe Price Blue Chip Growth Stock. This is actually a really good ETF or mutual fund. I don't have a problem with it. But we could reduce that by $100,000 and put it in something else that's safer, something to be on the sidelines if you want to be, right? And here comes the rain, so it's how you know I'm about to finish this video. So that's the bottom line there. When you start working with an advisor, or if you are they asking those questions? Are you doing the basic planning, the basic investment stuff to get you to the point where you go, hey, advisor person, what's the least amount of risk I have to take in order for my plan to be successful? I don't want to hear no general stuff. I want to know specifically what is it that I got to do. And if they won't help you out, I hope you'll check us out at jazzwealth.com, or doughstraight.com actually is another way you can look at it. I will wish you a happy Friday, and we will see you again next week.
Why should you choose Jazz Wealth as your retirement or long-term investing service? Our portfolios are managed by us, not some faceless mutual fund manager. Our private classes will teach you everything about investing and getting your dough straight. Best of all, our fiduciary standard means your best interest comes before ours.